And we're back. Let's continue our discussion on financial planning. We left off on forecasting our financial needs. So now, make this personal. Think about what are your short term forecasts. So you're predicting how much money do you expect to bring in within the next year? What type of costs and expenses do you expect to take place within the next year for your rent, car note, insurance, student loans, food, entertainment, etc.? And of course, with long term forecasting, you're predicting the same thing, but for a time period longer than 1 year. Now, to assist that, we prepare what's known as a budget. A budget sets forth management expectations and allocates the use of specific resources throughout the firm. So what a budget does, it shows the expected cash inflows, where they're coming from, the expected cash outflows, how funds are going to be used. Are they used for salaries, for advertising, for supplies, for taxes? A budget depends heavily on the statement we covered in last chapter, statements such as a balance sheet, an income statement, statement of cash flow, and again, we're going to have our short term and our long term financial forecast. The budget, that is your guide for financial operations and expected financial needs. And we'll take a look at the components of a budget. A blank budget highlights a firm's spending plans for major asset purchases. If you said B, that would be incorrect. Haha. A is the right answer. A capital budget, we'll talk more about, highlights a firm's spending plans for major asset purchases. Speaking of, now we look at the different types of budgets: a capital budget, cash budget, operating, or master budget. Capital budget highlights a firm's spending plans for major asset purchases. So if it's our intent to build a new factory, we plan to buy more equipment, new automobiles, those are capital budgets, a spending plan for major asset purchases. Your cash budget estimates your cash inflows and outflows during a period like a month or a quarter. So again, we're saying what are the expected cash inflows for the next month? What are the sources of those expected cash inflows? What are the expected cash outflows for the next month? And again, for what? It could be for rent for you, utilities, insurance, car note payment, rent. You get the point. So we're estimating the cash inflows and outflows for a period of time. When you combine your cash budget and your capital budget, along with others, together they make up what's known as an operating or master budget. This is a culmination of all the firm's other budgets and summarizes it into proposed financial activity. So here we see a sample cash budget for a company called Harvest Gold. It shows the projected sales forecast for the first 3 months of the quarter. It shows the amount we expect to collect in sales each month of the first quarter. It shows the actual cash outflow. So here you have your cash inflows. This is showing your cash outflows. So for February, see that we expect to collect 49,000, but spend 42,000. Therefore, you will have $7,000 cash flow in the month of February. However, we began with a negative balance of 1,000 in our cash account, so the total cash would be 6,000 at the end of the month. For this company, they want to maintain a minimum cash balance of $6,000. Therefore, they don't have any excess cash in the month of February to purchase any type of investment. Compared to March, they will have an excess of $5,000 based upon the expected cash inflows expected cash outflows added to the monthly balance. So the cash budget shows you, which I recommend that you prepare one for yourself. It shows your expected cash inflows, expected cash outflows for a specified period of time. Okay? Now, I mentioned this term financial controls. These are policies and procedures put in place to develop a process in which a firm periodically compares its actual revenues, costs, and expenses with its budget. So we expect to bring in for the next quarter $100,000, right? It's now the end of that quarter. Did we bring in more or less than our budget amount? Same for your costs and expenses. Our costs were expected to be this amount, but we end up spending this much. You identify what we call variances. Variances are the difference between your budget and your actual. They could be favorable or they could be unfavorable. Okay? So typically, you review this on a monthly basis to see again, and if our expenses are more than what we expected, why are they higher? If we earn less than what expected, why is that? So what can we do differently so that the next month or so we have a favorable experience comparing budget against actual? Okay? So we have to ask questions to make sure that we have control over our finances. Is the firm meeting its short-term financial commitments? So we take care of our obligations as they become due. Is the firm producing adequate operating profits on its assets? So when we acquired that new facility or we bought those new machines or new automobiles, are those assets being used to bring in a profit? How the firm finances assets? So we have this new equipment or this new building. Did we take out a loan? Did we issue bonds? Did we pay for it in cash? How do we finance these new assets? Are the firm owners receiving an acceptable return on their investment? So if we have stockholders or investment, or they receiving the required return on their investment? Okay? So every company needs operational funds, right? We need money in order to take care of the day-to-day needs of the business. We also need to have put in place controlling the credit operation, meaning that if we are buying things on credit or allowing others to pay us using credit we talked more about, we need to have control over that process. We need money to acquire more inventory and to make capital expenditures. So to give you more definition of a capital expenditure, these are a major investment in either tangible, long-term assets such as land, buildings, and equipment, or intangible assets such as patents, trademarks, and copyright. So again, these are the assets shown on the statement known as a balance sheet. Controlling credit operations. It's difficult to think of a business that doesn't make credit available to its customers. However, collecting account receivables can be time consuming and expensive. So we're saying if I offer you a product and or service, I can extend you credit, say, well, allow you to pay me in 30, 45, 60 days, but that can be timely and expensive. As an alternative, I can accept credit cards as a form of payment where you simply use your credit card to pay me for that product and or service. That's going to guarantee me payment right away from the credit card company. Question is, and send me an email, what type of products do you regularly purchase with the use of your credit card? I'm curious to know. Again, what type of product do you regularly purchase from the use of your credit card? Okay. Now, how can small businesses improve their cash flow? Well, they can raise prices. That may be one option, but at the same time, we can't raise them too high to the point where we're going to lose clientele. We can be more aggressive in collecting account receivable. We can do things such as offer a discount for paying early. We're saying that I know that I gave you 30 days to pay, but if you pay within, say, 10 days, I'll give you a 2% discount. Take advantage of special payments terms from vendors. So sometimes our vendor may give us a longer time period of pay that would allow us to manage better our cash flow. And then using credit cards carefully. Key word here, using credit cards carefully. Credit cards can be used as a form of cash flow, but it's very important that if you use credit cards, that you're paying that credit card balance in full as that payment becomes due. All right. We now look at some other sources of funding: debt financing and equity financing. Whenever you hear the term debt financing, that means you're going to borrow money. And we'll talk about the different ways that a company can borrow money. The word equity means ownership. So with equity financing, it is money raised from within the firm, from operations or through the sale of ownership in the firm, in terms of stock or venture capital, and we'll discuss those in more details. So I'll discuss the stock portion now. So when public corporations issue stock, what they're doing, that's called equity financing. They are selling ownership interest into their business organization. Because when you become a stockholder, you do become part owner of that business organization. And again, I'll speak in more terms of what's meant by a venture capital. So if it's short-term fund financing, funds needed for a year or less; long-term financing, funds needed for more than a year. So short-term fund may be used for monthly expenses, unexpected emergencies, buying more inventory, etc. Long-term fund could be for the product, develop a new product, merger or acquisition, new facility, or expansion into new markets. So remember, your budgets, your planning process will let you know what are our needs in terms of short-term funds and for long-term funds. Trade credits. What does that mean? I'm so glad you asked. So when companies buy from other companies, typically they do not pay cash upfront for those goods or services they receive, what's known as trade credit. Trade credit allows them to receive a product or service now and pay for it at a later date. They may get terms such as 2/10, comma, net 30, which says that you have 30 days to pay us, but if paid within 10 days, we'll offer you a 2% discount. Often they sign what's called a promissory note, which is an agreement with a promise to pay to the supplier a specified sum of money at a definite time. So be aware that companies do not pay cash up front for those products or services. They use what's known as trade credit. Time value of cash. One thing you can never have too much of is cash. Financial managers must make certain there's enough cash available to meet financial needs daily and still have funds to invest in the future. But here's the question and send me a response. What does it mean when we say cash has a time value? Again, what does that mean when we say that cash has a time value? Okay? When we come back, we're going to talk about different ways to obtain short-term financing, different ways to obtain long-term financing. Okay? So stay tuned for more information on our Chapter 18 lecture. Bye-bye.